Stocks remain in a range ahead of the crucial inflation print in the US today. Cement and metal stocks are the big gainers, even as financials drag.
Cement makers are reported to have increased prices by around 10 to 30 rupees a bag in December. The move raises hopes of prices stabilizing at higher levels, driving stocks higher.
Vishal Megamart's 8,000 crore rupee IPO opens for subscription today, as does a 3,000 crore offer from Sai Life Sciences and a smaller 570 crore offer from MobiKwik. Large share sales by private investors in Vishal Megamart and Sai Life Sciences are a key feature of their offer. MobiKwik's IPO is already subscribed.
Sanjay Malhotra takes charge at the RBI today, with industry watchers expecting a more balanced approach from him on key policy matters like project financing and expected credit loss, given his experience in the financial services. Hello and welcome to Halftime Report. I'm joining on the show today with my co-anchor Hormuz, and I'm Nigel. Hey Hormuz, good to be on the show midday. After a while, I'm here, but market's looking quite good. And you know, the Nifty bank that was actually underperforming when I was last on air at around 11 a.m., well, that's done a bit of a U-turn. It's on the verge of moving into the green. And things look pretty good, I think.
Good afternoon, Nigel, and welcome to the show. Well, it's the markets. Well, it almost seems like they're in snooze mode, right? That has been the case since Friday, awaiting some very important data points from the US tonight, from India tomorrow when it comes to the inflation print. But they're respecting the levels as of now, right? Both the lower end and the upper end, hovering between the 50 DMA and the 100 DMA is the Nifty. And it continues to remain in that 24,500 range on the downside, 24,800 on the upper side. The broader markets continue to do well, though. The small cap index is up 0.5%. The mid-cap index moving sort of in line with the benchmark indices. The Nifty Bank, as Nigel was highlighting, has recovered from the lows of the day, as has the PSU Bank Index. What's doing well, though, among sectoral indices is the metals index, and 9/10, almost 1% higher now, is the metals index. Some contributions also coming in from auto, and FMCG, after the battering it received at the start of the week, is seeing some bit of recovery in today's session. But a sector that is doing well since the morning is cement, and that is reacting, as the stocks are reacting to brokerage note by CLSA. Tell us more about that, Nigel.
Well, let's break it up into three parts. One is on cement pricing. You know, CLSA says that prices have been increased by anything between 10 to around 30 rupees a bag in December. They are saying that for Q3 so far, pricing is higher by around 3.5% on a sequential basis, though on a year-on-year basis, it's still down by close to around 5%. They're saying that these price increases have to hold because consensus estimates are bracing for a 4% price increase in the second half of the fiscal in comparison to what we saw in Q2. So these price hikes that have been taken, they need to sustain all the way into March. I think some of those graphics should come up for our viewers as well. On demand, they acknowledge that yes, October was a slow month, but there was a recovery that was seen particularly in the second half of November. And now they're expecting that momentum to be maintained. Post-November, they're expecting the second half of the year to see a good amount of demand. And also in FY26, they're expecting to see a fair bit of demand. They've assumed sharp volume recovery. Cost, as we know, have cooled off a little bit, particularly on pet coke prices. And operating leverage will play out, which will help the EBITDA number for the second half of the year. In terms of preference, they're remaining selective. And they believe that Ultratech Cement is one of the preferred stocks from the space. So cement stocks, they're taking heart from the fact that after a while, some of those price increases are finally getting pushed through. Though we'll have to see how much of that price hike is absorbed to Hormuz, because as we know, it's winters, it gets very cold, particularly in parts of North India. And we could see some cooling off in terms of activity as well. For the time being, the street likes it.
Yeah, interesting, right? Hiking prices right after monsoons are over, entering into a new season as well. It's showing up in the stock price as well. Well, modest gains, if you can say that, off the highs of the day are most of these cement names, but continuing to hold on to remain in the green. Now, some of the other stocks that are on the move today on the downside, first up, Swiggy is one of them. It's seen a very strong move from the IPO price, but today it's seeing a bit of a correction, 4.5% lower, and Mangalam is here to tell us why. Mangalam.
Swiggy is under pressure in today's trading session. Remember, it was just a month ago on November 12th where Swiggy listed on the bourses. So as a result of which the 1 month lock-in period for a lot of shares were up until December 10th, making today, December 11th, these shares open for trade itself. So the lock-in on 6.5 crore shares, which is roughly 3% of the company's equity, opens today. And with this, nearly 12% of the company's equity is open for trade currently. Important date to watch out for would be, Jan 28th and Jan 30th on this account itself, where the next batch of shares open up for trade.
Lock-in periods opening up for Swiggy, 4 other companies as well. So more companies opening up tomorrow. We keep an eye out on all of these names. For now, Swiggy 4.5% lower at the lowest point of the day. Time for a short break. Up next, we'll be joined by Kapil Makhija, the Managing Director and CEO of Unicommerce eSolutions, to discuss their recent tie-up with the sportswear brand Hummel. Stay tuned. Back on the other side. Back with us here on Halftime Report, and before we get to the management of Unicommerce, let's take a look at some of the other buzzing stocks today. PNC Infra is one of them, is up over 11% after its arm completed a 738 crore rupee project ahead of its deadline. Vivek is joining in to tell us more on that. Vivek.
Well, that's right. So PNC Infra, the infra space is buzzing today. It's on the back of various project completions, project awards, and in the case of PNC Infra, its arm, like you mentioned, Hathras Highway, has completed a HAM project, a hybrid annuity mode project, worth 738 crore. This has been done ahead of schedule. The company says this makes it eligible for an early completion bonus. One thing to note, remember PNC Infratech has been barred by MORTH, which is the Ministry of Road as well as Transport. This is on the back of the fact that the company actually had quite a few issues as far as the bidding was concerned. So for a period of a year, the company cannot participate in MORTH projects. Remember, on the back of that particular development, the company has given a guidance of degrowth as far as FY25 is concerned. Order inflow guidance for FY25 has been maintained in the range of 13 to 15,000 crore.
All right, Vivek, thanks a lot for that. PNC Infratech up almost 10.5% higher in today's session. Where the other stock that's not having a very good day, though, is Avenue Supermarts, and that is after Goldman Sachs cut its price targets and earnings estimates for the company. Mangalam is back with more details on this. Mangalam.
Well, DMart is under pressure in today's trading session on the back of a Goldman Sachs note where they've cited pressure coming in from all the other quick commerce players and the competitive mode when it comes to value retailing for DMart thinning itself. The company has gone ahead and looked at increasing discounts, to match the competitive intensity as well. And while a large part of their stores are in the metros, the headroom for growth comes by beyond the top 10 cities itself. And to that extent, will be very important to see the store opening for DMart going forward. Citing lower revenue expectations, Goldman Sachs has gone ahead and cut their FY25, 26 and 27 EPS estimates by anywhere between 4 to 6 odd %. And that's led to a target price cut as well from 4,000 to around 34.25. They always remain seller on the stock, and as a result of which we're seeing further decline in DMart's stock price today. Mind you, the stock is now in FNO, so one can take fresh short positions out here, enabling a further downside risk on the stock. So we'll keep an eye out on that, because up until last month, it was only a cash traded stock.
Got it. Thanks a lot for that, Mangalam. For the time being, we'll slip into a short break. On the other side, hopefully we'll get chatting with Unicommerce eSolutions to discuss their recent tie-up with a sportswear brand, Hummel. Stay with us.
Welcome back. You're watching us on Halftime Report. Let's get chatting with the management of Unicommerce eSolutions. Kapil Makhija, the Managing Director and CEO of the company, is joining in. Kapil, good afternoon. Thank you so much for joining in. I'd club two questions into one, right, because of your recent tie-up with Hummel. How has the growth been in the sportswear segment as a whole? I'm sure it must be at a decent scale considering that you've tied up with Hummel. If you could share a number on that. And how is this Hummel tie-up going to support your growth going forward?
First of all, good afternoon. I'm glad to be here. Thanks for inviting me. I think we are, as we mentioned on your show before as well, we are an e-commerce enablement SaaS platform. So a lot of brands today work with us to manage their e-commerce operations. Our partnership with Hamal is in a similar line, where we are helping them streamline their post-purchase journey. Our vision is to become a one-stop shop for e-commerce enablement, and with the recent acquisition of Shipway, we have been able to now ensure that we have a full stack. So today, Hamal is enabling an end-to-end post-purchase journey management through our stack, where we are helping them manage their multiple demand channels along with their multiple warehouses. Uh, we are seeing the e-commerce growth across many sectors. Although we've seen the last year was a bit soft for e-commerce, and we've seen the softness continue this year as well. But we are seeing many categories demonstrating strong growth. We have published a recent report on festive season growth as well, where categories like beauty and personal care, sport, etc., are doing well. We are a sector agnostic platform, so we work with brands across multiple categories. Along with Hummel, we've done partnerships with Healthcart, Landmark Group, and many others. So I don't think there's a specific focus on a sports category per se. We are a sector and a scale agnostic platform, so we continue to onboard brands across different sectors and help them streamline their post-purchase journey so that the experience for end customers which shop on various brands such as Hamel, their experience gets streamlined. So that's our main intent as a software platform.
Got it. All right. So you're indicating that there is a good growth potential from year on, good business potential, and you'll have to see how this pans out. Any more signings should we be looking forward to, in the coming month?
Yeah, so we continue to add a lot of logos. We added 100 plus enterprise logos in Q2. So we continue to add logos across various sectors, and we will continue to publish them on a regular basis. We continue to be a trusted choice by many brands across varying sectors, across varying scale. We work with the likes of Mama, Sugar, M Caffeine on the D2C or digital first brand side, as well as many traditional brands like VIP Bags, Fab India, PCNS, Imami, etc. So we continue to be a trusted platform for many brands across many sectors.
Yeah. So you added 100 plus logos, I think, in the past quarters, what you said. From year on as well, should that be the quarterly run rate that you're looking at?
Hard for me to comment on that. Typically in during the festive season, there is a bit some brands take some time to adopt a new solution. But I think on an annual run rate basis, we continue. Like in Q1, we did about 85 acquisitions, 100 we did in Q2. So we'll continue with that similar run rate in the 85 to 100 sort of a run rate on a quarterly basis.
Kapil, before we get to other aspects of your business, you mentioned Shipway in your first answer. Get to that and get that out of the way first. It's still currently loss-making, right? For FY24, Shipway's net loss was around about 2 crores. When do you expect that to break even, one, and then turn profitable as well, if there is a timeline?
Sure. If you look at the trajectory for Shipway, they have already, on a standalone basis, they've been working on improving the loss trajectory. So in FY23, they were at a 42% PAT loss. In FY24, they were only at a 5% PAT loss. So there has been a significant improvement in their profitability as a business on a standalone basis. On top of that, by joining hands, today we see a lot of synergies on the cross-selling side. Combined entity of Unicommerce and Shipway has a customer base of 6,500 plus brands and sellers on which you can cross-sell both the company's solutions. So that help get a revenue boost. Plus, we see synergies on the cost side, both direct and indirect. And that's why our intent is that by joining hands, seeing the synergies that we have, we are hopeful that we should be able to turn the business around and make it profitable very soon and continue on the growth trajectory as well. It solves a very important pain point because courier aggregation, which is a space in which Shipway plays, is a large market opportunity. It's nearly a 4,000 crore market opportunity. And that's why it has significant potential for us to build a consistent growth on our top line. And on top of that, it helps us fulfill our vision of becoming a one-stop shop for e-commerce enablement, because for brands in India, they now get everything under a single umbrella.
How soon is very soon, Kapil? Because you mentioned very soon. If you could give us a timeline, right? By the end of FY25, by FY26, when does Shipway turn profitable? If the street would want to know that, right?
Yeah, sure. I think it'll be hard for me to comment on the timeline, but what I can definitely assure you is that's one of our key priorities, and we are very hopeful that we should do that very soon.
All right. Kapil, we want to understand about how quarter three is panning out without getting into numbers. So give us your sense about how the festival demand was and also the Black Friday sale. Better than estimated, demand was strong. Your initial take.
Yes, so I think we have seen during the sale period, we see some strong uptick. The Diwali festive season also, we published a report where we saw 15 to 20% spike. I mean, we've seen a similar spike during Black Friday. But what happens just after the sale period is that the softness in the overall demand continues. So there is some spike that we see during the sale period, but beyond that, the softness continues as we'd seen in the last year. So while the quarter is yet to end and there are more festive sales coming up in terms of end of season sale, etc. So I think we'll be able to comment on quarter three better once this month closes by. But I think as a theme, what we are seeing is that we see certain amount of spike during the festive sale period, which could be a week or few days. But beyond that, the softness in the e-commerce market continues.
Kapil, your volumes during the second quarter grew 22%, right? That was because of the additions of enterprise clients. Your enterprise clients number stood at around 904 at the end of the second quarter. What do you expect to end the year with? And does this 20% plus volume growth trajectory continue going forward as well?
See, a lot of our volume growth is driven by growth of our existing customers. So very hard for us to comment on how they are going to grow because we are a very sticky solution. Once a customer adopts our solution, it is sort of a marriage for a lifetime. They continue to use us for a very, very long time. It becomes a lifeline for their business. So a lot of our transaction growth is a function of our existing customers growing along with the market. So our transaction growth is a function of how the market is growing. As I said, during the sales season, we are seeing this 15-20% sort of a spike, and after that there is some softness that continues. So once the number come in for December, we'll be able to talk about the transaction growth. So a part of it, part of our revenue growth is also driven by new client acquisition, because new clients, once they come on board, they take some time to put in their full volume. So I think a lot of our transaction growth is a function of the existing clients growth, and the revenue growth is a combination of existing clients and new clients.
Got it. Kapil, what is the margin guidance you can give us? Because it's very volatile. Very quickly, if you could give us a number.
So we've always been consistently demonstrating operating leverage in the business. Our margins have always expanded faster than the revenues, and we are hopeful that we'll continue to demonstrate that trajectory going forward.
Right. All right, Kapil, thank you so much for sparing time and joining us. Wish you good luck for the second half of the year, the management of Unicommerce eSolutions. Time for a short break. Up next, Lata will be in conversation with Neelkant Mishra of Axis Capital on India's economic outlook for 2025. Stay tuned.
Hello and welcome to our special year-ender series, Indian Economy in 2025. And today we have a very special guest. We have Neelkant Mishra, the Chief Economist at Axis Bank. He has just published the bank's outlook for India in 2025. And remember, he's important. He's also a member of the Prime Minister's Economic Advisory Council, besides being one of the leading equity strategists in the country. Neelkant, thank you very much indeed for joining us.
Thank you for having me.
Well, first up, let me start with domestic. Though the world is going to cast its own shadows, I noticed that your FY26 forecast is 7%, highest on the street. Now, when you look at the Q2 numbers, 5.4%, you kind of feel that we are not in the 7 league. We are probably in the 6.5 league. What makes you so confident of 7?
Well, the extent of fiscal and monetary tightening that we saw was extreme. So just to give you perspective, generally, the central government incurs about 62% of its fiscal deficit in the first half. This year, it incurred about 29%. So there was a 33% slippage. And on a 4.9% of GDP worth of fiscal deficit, that means there was a 1.6 percentage points of GDP of fiscal consolidation squeezed into just 6 months. That's a very strong phase of tightening. Secondly, you saw a 4.5% decline in the credit growth. And that was because first there was a quantity of money problem, then perhaps with the regulator talking down loan deposit ratios, which we have discussed on your show earlier as well. If you see a 4-5% points of decline in overall credit growth, obviously the economy is going to slow down. Now, as we start to see the recovery, as the government spending picks up, I think these tailwinds will last into will build momentum into FY26. We think that the CRR cut was very necessary. I think it helps bring sustained money into the economy. So as you know, it's base money, it is high-powered money. 1.16 trillion could actually become 5 to 6 trillion over time. And this should suffice to bring credit growth back. We also expect, this is not yet there, and of course our 7% growth forecast is predicated on that there should also be, there is likely to be, in my view, some more macroprudential easing so that credit growth starts to bounce back up a bit.
Okay. Now, I take your point that we had an extraordinary loss of liquidity and fiscal curbs. But let me come to even the latest data we are getting. Look at the Godrej consumer numbers. That's not looking, it's not as if something has picked up now despite the increase probably in fiscal spending. And secondly, the unsecured loans. I can understand MFI loans. Maybe they are, victims of seasonal variations. But unsecured loans, how many banks? IndusInd Bank showed us, RBL, IDFC a bit. I mean, if I remember, there were 4 or 5 banks, Kotak as well. Unsecured loans, two-wheeler loans are going down. That there is an income problem, isn't there, if FMCGs are not being bought?
See, when overall credit growth, overall economic growth slows down to 5.4%, though we must be very careful with these quarterly GDP statistics. I think there are more estimates than measurements. But it was very clear that things had slowed down. So if things slow down, obviously loans will go bad. See, remember that if you were expecting 7% growth or the equivalent of income growth that comes from 7% real growth, and your growth is 1.5% lower, there will be large segments of the population which are struggling for liquidity. And what then happens is that everyone pulls off their hands. So just, as you know, people don't go bankrupt because of insolvency. They go bankrupt because of illiquidity. And then liquidity dries up, and then even the individuals or the entities that were not supposed to go belly up, they start going belly up. So now, once the overall economic momentum picks up, that's the best cure for the challenges of bad lending. But remember that the unsecured personal loans and MFI, I think there were excesses starting to happen at the fringes. And so some kind of correction was needed. But I think what has happened because of the attempt to control lending in those segments is that a much broader credit slowdown has been engineered. I mean, there's no reason why, for example, mortgage growth should have been slowing down. So as those start to pick up, I think you will see much better momentum. One final point on consumption. Remember that this is likely to be an investment-driven recovery. So investment to GDP is likely to keep going up. And when that happens, so even if your GDP growth is 7%, your investment growth may be 8 or 9, maybe 10%, and your consumption growth could be 4.5 to 5%. Within that, there will be a divergence. At this stage of development of the economy, inequality is bound to go up. And therefore, the segments like FMCG may only see 3% growth. And some of the segments which cater to the higher income households may see faster growth. So this is not at all evidence that overall economic growth cannot be strong.
Okay, you mean there could be a bit of a K-shape in this and we could still grow at 7%. Now, your arguments convince me that we are not a 5.4% category. But I'm not still convinced we will catapult over this 6.5% mark to 7, because on hindsight, it appears that we were able to manage that 7% plus for 3 years because of very large fiscal largesse. Now, that is going to come down, isn't it?
No. So okay. See, the theory says that an increase in fiscal deficit supports growth.
Yes.
A decrease in fiscal deficit is a headwind to growth.
Yes.
So we went from, so forget about the 9.5 to 6.9. See, that
was
had
an
to
unusual
happen,
one. Yeah.
unusual thing, right? But 6.9 to 6.4, 6.4 to 5.6, 5.6 to 4.9. These are substantial reductions in fiscal deficit. So I think the economy was doing fine as it opened up and as people started to spend or as the economic activity normalized and able to withstand the fiscal consolidation. But if you do the equivalent of 1.6 percentage points in 6 months, there is bound to be an impact. The economy could not withstand that much. Now, think about it this way. In the next 6 months, as the government catches up, and October has already been a pretty good month in terms of the pace of fiscal easing.
Yeah.
And so you may actually end up with a much lower pace of fiscal deficit than you had in the first half.
Okay.
And which means that there will be an impetus to growth. And you are starting to see, you must have seen that, car registrations have picked up in November. There is an improvement in some power demand. There is improvement in the number of launches of real estate. So there are signs that October was the bottom, and we are starting to recover. I am 100% with you that there will be a debate and a discussion on whether, when we rebound from here, we land up at 6.5 or 7 or 7.5. I do think that our trend growth is 7. So if we don't artificially slow ourselves down through policy measures, I think we should be able to get back to 7%.
Okay. I'm not very sure that some of these slowdown measures will go away. For instance, overall fiscal deficit is also designed to go down up until 4.5%. And we have a problem of incomes. We've probably created jobs, but we have not created jobs with high incomes. So are you convinced about consumption? And will people invest in capex without consumption? Both those questions together.
Yeah. So see, GDP growth is income. I think what you're worried about is
low incomes.
Growth, low income growth. See, that's a political problem. And I think it's a very serious political problem. If we don't solve it, our reform momentum will have to be reversed. A lot of other things will start to happen. But it is a political problem. It's a redistribution problem. It is not an income problem, income generation problem. Because if you're growing at 7% real and most likely 11, 12% nominal, that's a very strong pace of growth. Now, how you're distributing it actually becomes an issue. At this stage of development of economy, where labor is generally in surplus and capital is the constraint, the labor share of income, because labor has lower bargaining power, it generally tends to fall. And that is what you are seeing reflected in these things. So the capex recovery that we are talking about is a reversal of the slowdown that happened between 2012 and 2021, where of the 7% points decline in investment to GDP ratio, 5% points came from real estate. And I would say 1.5 to 2% came from the decline in investments in new power capacity.
Okay.
And the rest came mostly from areas which are inputs to real estate, like metals, like cement, like construction machinery. Now, if housing construction really picks up, and I think that policymakers should actually focus on that, I think the investment cycle will be up and running.
welcome back. A few stocks in the broader markets are bucking the trend. You have macro tech developers in the last few minutes. The stock has seen a bit of a spike up, volumes as well moving up. And Indian metals and ferroalloys, that's IMFA, the stock saw a bit of a spike, volumes as well moved up. It's cooled off a little bit from the top, but this is one stock that we have been telling you here on CNBC-TV18 all through 2024 that there is a chrome ore shortage. And that's what's holding them in good stead. Irrespective of what demand is, there's a supply problem. And that's why ferrochrome prices are up. So the stock, almost ₹1,000 stock, I think we have been telling you from around 600, 650 or thereabouts about the shortage. And now it appears the street as well is taking note of that. Let's focus on the options data, though, as of now. The 24,500 put, well, that's seeing a fair bit of action. In yesterday's trading session, we went down to a low of around 24,510 and we bounced from there. So in the near term, the 24,450 to around 24,500 marks becomes extremely crucial. There's a technical level there, and that's what the options data as well is suggesting. On the upside, though, you'll have to get past the 24,750 odd mark because there is some action even at that particular strike. Let's get that up for you, 24,700 call. So it appears we're in this very, very tight band for now. Keep in mind, there is some writing that we're seeing at around 24,700 call. Why do I say that? Because you have the markets that are up. So you got the direction correct. However, the time value of money is getting eroded. So that's why the premium out there has come down. So that's telling you that call writers, they believe that we're not going to end this series, which finish off tomorrow, the weekly expiry. We're not going to end above the 24,770 odd mark. That's the options data broadly what it's telling you, not the series, but the weekly options contract. These contracts expire tomorrow. Stocks that I'm looking at, I remember there were two stocks that I had pointed out in my morning chart. One is Manappuram, the other one is Granules. Why did I point them out? Because there was a lot of shots that were getting built into the system. And both these two moved into the F&O ban. So both these two from there actually have seen a fairly decent recovery. Manappuram as well has moved up. Granules as well has moved up quite a bit. In fact, now it's moving to those levels we saw prior to that price, when in fact we had that announcement on the exchange. The stock had cracked from 600 to around 520 and it's bounced back from there, both of them in the F&O ban. The other one I'm looking at is Vedanta. I think the street is sensing that demerger date is coming very, very close. And that one has spiked up in the cash market as well. We've seen a fair bit of action. And in the F&O market, there appears there is a fresh amount of fresh buying. And finally, Metropolis. No worries on that front. The news yesterday was fairly positive. But there's some unwinding of long positions. The news that we got yesterday with regard to their acquisition is good. It's going to add a good amount in terms of revenues as well as profitability in the time to come. But for the time being, some unwinding of positions is what we're seeing there, Hormuz.
Indeed, and we'll keep an eye out on all of this. Of course, tomorrow is the weekly expiry as well, right? So some bit of choppiness you could expect on that front as well. But Pritesh Mehta, Senior Vice President of Research at Yes Securities, is joining us right now. Pritesh, good afternoon. Thank you for joining in. The Nifty continuing to meander in this range, right? That 300-point range, 24,500, 24,800. Which side has more legs for a break on either side? Does the upside have more legs or the downside has more legs sooner or later? What's your call there? And couple that up with your stock recommendations as well.
Yeah, good afternoon, guys. Now, see, yes, the bias is on the upside, but the way I look into things is that we have entered a year wherein action takes place beyond the index. So, yes, we have got a good solid base on Nifty around 23,200. There was a strong up move, and last few days has told us that Nifty is going to consume time. It's not going to move up in a hurry, but focus should be on the broader markets. When you look at the ratio of small cap versus Nifty, mid cap versus Nifty, they will surpass multi-month peaks. So I think this is a place where our focus should be. We have seen action picking up in side sector, sub-sectors, something like railways, something like defense, something like textiles. This is a space popping up last few days. So this is the way that, our attention to be for short-term trading opportunities. As far as index is concerned, yes, 25,000 is short-term target possible next few weeks. When we move on to stock ideas, the one which we like is Voltas. Now see, the stock currently last few weeks. It built up solid base. We have seen a bullish data breakout coming in on short-term charts. So buy for target 2,000. The stop loss would be around 1,700. The second stock that we like is Emphasis. Now, mid-cap IT stocks are doing extremely well. So in this particular counter, we have seen a big bullish, column back in the month of June. There are sideways consolidation. Now it's trying to surpass the recent peak. So I feel that the stock can rally towards 3,700 levels.
All right, Pritesh, thank you so much for sparing time and joining us today with your views on the index and specific stocks as well. With that, we slip into a short break. More on the markets and specific stocks on the other side. Stay tuned. Back with us here on Halftime Report. Plenty of movers in the broader markets, and railway stocks are prominent among them, and they're making a comeback of sorts because all of them have seen some bit of recovery from the lows that they had made in the month of November. IRFC, you can see on your screens, 4.5% had at one point was up 5.5%, but still holding on to gains. All of them are off the highs of the day, but still significant gains seen there. Railtel, a 3.5% move there as well. Ircon International as well as RVNL, the other two names as well, both of them also seeing healthy gains in today's trading session. Ircon 2 up almost 5% and RVNL2 trading with gains of 3.5%. You know, RFC is also an entrant in the FNO space from this series, and since then, from the 29th of November, the stock has moved almost 10%. Its low in November was around 137. It's recovered now to levels of 164. But a stock that we've been focusing on is Triveni Engineering. Now it's come off the highs of the day. It's turned negative, and that is because the company announced a restructuring, after which the sugar and distillery verticals will be under one company, while the power transmission business will be demerged and eventually listed on the exchanges as a separate entity. Vamakshi has all the details on the restructuring plan, the valuations and more. Vamakshi, over to you.
Well, that's right, Hormaz. You know, Triveni Engineering is in focus on the back of the scheme of arrangement. And now, just to make our viewers understand this better, let's divide this whole scheme of arrangement into two parts. The first part being that, the company will undertake an amalgamation of Shadilal Enterprises with Triveni Engineering. Now, keep in mind that both of these companies have manufacturing verticals of sugar as well as distillery. And therefore, this amalgamation would lead to consolidation of operations as well as several operational efficiencies. Now, the shareholders of Shadilal Enterprises will be receiving 100 equity shares for every 137 equity shares. So, roughly when we calculate basis the closing price yesterday, the ratio favors Shadilal Enterprises by almost 1%. The second part of this restructuring is with regards to the demerger of the power transmission business. Now, they will be spinning off the power transmission business. This will be housed under a separate entity called Triveni Power Transmission, and this in turn will be listed separately on the exchanges. Now, keep in mind that the share entitlement ratio out here is as follows, that the shareholders of Triveni Engineering will receive 2 shares of Triveni Power Transmission for every 3 shares that they hold in Triveni Engineering, and this in turn could lead to value discovery as well as the unlocking of value for the shareholders of Triveni Engineering. Now, let me quickly take you through the financials for the power transmission business. Keep in mind that it contributed nearly 5% of the consolidated revenue in FY24 and 17% as far as the EBIT is concerned. So it is a high margin business. In the first half of this year itself, the company, that is the power transmission business, saw an uptick of 18%. Its margins improved by nearly 49 basis points. And now coming to the valuations, let me first put into picture the assumptions that went behind this. So on an annualized basis, we consider the EBIT to be 113 crores, and keeping in mind that the average EV to EBIT for similar power transmission businesses are somewhere around 35 times for the entire industry. If we value the company with an EV to EBITDA multiple of anywhere between 20 times to 30 times, the figures will come up for you on the screen. The equity value could range anywhere between 2,200 crores to 3,300 crores, valuing the share of this business of nearly 209 per share, or anywhere between 318 rupees per share. Therefore, PTB, that is the power transmission business, could account for nearly 20 to 30% of the overall SOTP based on the multiple given to it.
Thanks a lot, Vamakshi. A very detailed explainer on the restructuring that Triveni Engineering is undertaking. But with that, it's a wrap on this edition of Halftime Report from Nigel, me and the team that put this show together. Thank you so much for watching. Business Lunch up next.